Something that might surprise you about the way I think about money after 9 decades on this earth, after building one of the largest fortunes in human history through stock picking, through analyzing businesses, through reading thousands of annual reports and balance sheets. The single most powerful lesson I have ever learned about building wealth has almost nothing to do with picking the right stock. It has everything to do with understanding one concept that most people hear about, nod their heads, and then completely ignore: compounding. Now, I know you have heard that word before. I know your financial advisor has probably mentioned it. I know you have seen it on charts and in articles and in books. But I am telling you right now, you do not truly understand compounding. Almost nobody does. And the gap between hearing about compounding and truly understanding it in your bones is the difference between retiring comfortably and running out of money, between building generational wealth and leaving nothing behind, between sleeping peacefully at night and worrying about every market dip on the evening news. And today I am going to explain compounding in a way that nobody else will tell you. Not the textbook version, not the version your advisor gives you at the annual review meeting, the version I have lived for over 70 years, the real lessons, the ones that cost me money to learn, the ones that made me money when I applied them, and the ones that will change how you think about every single dollar you invest from this point forward. Let me take you back to 1942. I was 11 years old. I had saved up $114.75 from delivering newspapers and selling golf balls and running various little businesses around Omaha. My sister Doris had saved a similar amount, and together we bought 3 shares of City Service preferred stock at $38.25 per S-share. Now, that does not sound like much money, but in 1942, that was a significant sum for a kid. That was hundreds of hours of work. That was thousands of newspapers thrown onto porches before dawn. That was real sacrifice. And here's what happened. The stock immediately dropped to $27 a share. I watched nearly a third of our hard-earned money evaporate. Every single day I would check the price. And every single day I felt sick to my stomach. My sister Doris would remind me constantly that we were losing money, that it was my idea, that I had wasted our savings. The pressure was enormous. So when the stock finally recovered to $40, I sold immediately. I was so relieved to have a small profit that I could barely contain myself. Then I watched that same stock climb to $200 per S-share. That single decision, selling too early because I could not handle the emotional discomfort of waiting, cost me about $492. Now, $492 in 1942, adjusted for what that money could have become if I had understood compounding and simply held on. We are talking about millions of dollars in today's terms. Millions from 3 shares of stock bought by an 11-year-old kid. That experience burned a lesson into my brain that has never left me. The lesson was not about City Service preferred. The lesson was about time, about patience, about understanding that the real magic of investing does not happen in the buying or the selling. It happens in the waiting. And this is what I want to talk to you about today, specifically through the lens of something I believe every single investor in America should own: exchange-traded funds, or ETFs. I am going to walk you through 5 compounding lessons that most people never learn. Lessons that I wish someone had explained to me when I was that 11-year-old boy in Omaha. And I am going to show you exactly how these lessons apply to building wealth through ETFs in a way that is simple, powerful, and available to anyone, regardless of how much money you have right now. Before I get into these 5 lessons, let me explain why I believe so strongly in ETFs for the vast majority of investors. I have spent 75 years picking individual stocks. I read 500 pages a day. I understand accounting and corporate governance and competitive moats at a level that comes from a lifetime of obsessive study. And even with all of that expertise, I am telling you that most people, including most professional money managers, cannot beat a simple low-cost index fund over the long term. The data is overwhelming. Over the past 15 years, more than 90% of actively managed large Cap funds have underperformed the S&P 500 90%. These are professionals with degrees from the finest business schools, with teams of analysts, with access to company management, with sophisticated computer models, and they still cannot beat the index after fees. So when I tell my own family, when I tell the trustee who will manage my wife's inheritance to put 90% of her money into a low-cost S&P 500 index fund, I am not being lazy. I am being honest. I am giving them the best advice I know how to give. And the reason this works, the reason a simple fund that just owns the 500 largest companies in America can beat almost every professional on Wall Street, comes down to these 5 compounding lessons. The first lesson, and this is one that cost me real money to learn, is that compounding does not reward the smartest investor. It rewards the most patient one. Now, most people think they understand this. They nod along when someone says, be patient with your investments. But then the market drops 10% and they sell everything. Or they see their neighbor making money on some hot stock and they abandon their plan to chase it. Or they get bored because their index fund is just sitting there quietly growing, doing nothing exciting, and they think they need to do something. Let me tell you about a man I knew in Omaha back in the 1960s. Brilliant fellow engineer at one of the local companies. He understood mathematics far better than I did. He could calculate compound interest in his head faster than most people could do it on a calculator. And he was always trading, always looking for the next great opportunity, always convinced he had found some edge that the market had not priced in. Meanwhile, his wife had a pension fund that was invested entirely in a simple diversified portfolio of large American companies. She never looked at it. She never traded. She never worried about it. She just let it sit there and compound. By the time they both retired in 1990, his trading account had earned about 6% per year after all his transaction costs and taxes and mistakes. Her pension fund had earned about 10% per year. That 4% difference might not sound like much, but over 30 years of compounding, his account had grown his original investment about 5.7 times. Her account had grown about 17.4 times. She had roughly 3 times as much money. Not because she was smarter, not because she picked better investments, because she was more patient. She let compounding do what compounding does when you stop interfering with it. And this is exactly what happens when you buy a low-cost ETF, like one that tracks the S&P 500, and simply hold it. You are not trying to be clever. You are not trying to time the market. You are just letting the collective earnings power of 500 of the best companies in America compound year after year after year. And over decades, that patience is worth more than any amount of intelligence or sophistication. The second lesson of compounding, and this is the one that separates people who retire wealthy from people who struggle, is that fees are the silent assassin of your wealth. Now, I want you to really listen to this, because what I am about to tell you will make you angry. If you are paying a financial advisor 1% per year on your portfolio, and that advisor has you in funds that charge another 1% per year, you are paying 2% annually for the privilege of almost certainly underperforming a simple index fund. Let me show you what that 2% actually costs you over a lifetime. Imagine you are 35 years old with $100,000 saved. You plan to add $10,000 per year and retire at 65. If you invest in a low-cost ETF with an expense ratio of 0.03%, essentially nothing, and earn the historical average of about 10% per year, you will have approximately $5.7 million at retirement. Now, take that exact same scenario, but subtract 2% per year for fees and advisor costs. Your effective return drops to 8%. At retirement, you have about $3.4 million. You lost $2.3 million to fees. $2.3 million. That is not a rounding error. That is a house. That is your grandchildren's college education. That is the difference between traveling the world in retirement and worrying about your grocery bill. And here is what makes me truly upset about this. The financial industry has spent decades convincing people that they need expensive advisors and actively managed funds. They use complicated language and sophisticated sounding strategies to justify their fees. But the math does not lie. Every dollar you pay in fees is a dollar that is not compounding for you. It is compounding for them. This is why I am so passionate about low-cost ETFs. When you buy an ETF that tracks the S&P 500 with an expense ratio of 3:1, hundreds of 1%, you are keeping virtually every penny of your returns. For every $10,000 invested, you pay $3 per year in fees. $3, the rest stays in your account, compounding, growing, building your wealth instead of someone else's. I have said it before, and I will say it again. The financial industry is the only industry where the customer routinely pays for services that make them worse off. If you went to a doctor and the treatment made you sicker 90% of the time, you would find a new doctor. But people keep paying fund managers who underperform the index year after year. It baffles me. The third lesson of compounding is one that almost nobody talks about, and it is perhaps the most counterintuitive of all. The biggest gains happen at the end, not the beginning. This is what I call the hockey stick effect. And if you truly internalize this lesson, you will never panic. Sell during a market downturn again. Here's what I mean. Let us say you invest $100,000 and it compounds at 10% per year. After year one, you have $110,000. You made $10,000. Fine. After year 10, you have about $259,000. You have made about $159,000 in gains over a decade. Not bad. But here's where it gets remarkable. After year 20, you have about $673,000. You made $414,000 in the second decade alone, more than 2.5 times what you made in the first decade. After year 30, you have about $1.7 million. You made over $1 million in that third decade. $1 million in a single decade from an original investment of $100,000. And after year 40, you have about $4.5 million. You made $2.8 million in the fourth decade alone. Do you see what happened? The gains in the last decade were 28 times larger than the gains in the first decade. This is the hockey stick. The curve barely moves for the first 10 or 15 years, and then it explodes upward. Most of my own wealth was accumulated after my 60th birthday. I was worth about $3.8 billion when I turned 60. Today, decades later, I am worth considerably more than that. The vast majority of my wealth came in the later years, not because I suddenly got smarter, but because compounding had decades of runway to do its work. This has a profound implication for how you invest. If you are in your 20s or 30s and you look at your ETF account and it does not seem to be growing very fast, that is normal. You are in the flat part of the hockey stick. The magic has not kicked in yet, but if you stay invested, if you keep adding money, if you resist the urge to touch it, that hockey stick curve will eventually take over. And when it does, the growth will astonish you. The people who miss out on this are the ones who get impatient in year 5 or year 8. They look at their account and think this is not working. They pull their money out. They try something different. They chase some hot investment. And they reset the compounding clock back to zero. Every time you sell and start over, you are going back to the flat part of the hockey stick. You are voluntarily giving up the exponential growth that was building in your account. That is why I tell people the most important quality in an investor is not intelligence. It is temperament. It is the ability to sit still and let time do the heavy lifting. The fourth lesson of compounding is that dividends are the secret engine that most people completely overlook. Now, when most people think about ETF returns, they think about price appreciation. The fund goes from 100 to 110, and they made 10%. But that is only half the story, sometimes less than half dividends. The cash payments that companies distribute to shareholders from their profits are one of the most powerful compounding forces in all of investing. Let me give you an example from my own experience. I bought shares of a certain well-known beverage company back in 1988. I paid about $1.3 billion for my stake today. That company pays me over $750 million per year in dividends alone. Not from selling shares, not from the stock price going up, just from the dividend checks that arrive every quarter like clockwork. The dividend income alone is now more than half of what I originally paid for the entire investment. And I still own every single share, which are now worth roughly $25 billion. That That is what dividends do when you let them compound over decades. Now here's what this means for you as an ETF investor. When you own an S&P 500 ETF, you are collecting dividends from 500 companies. Historically, the S&P 500 has paid a dividend yield of roughly 1.5 to 2% per year. That might not sound exciting compared to the price appreciation, but here is the key. If you reinvest those dividends, if you use them to buy more shares of the ETF, those new shares generate their own dividends, which buy more shares, which generate more dividends. It is a snowball rolling downhill. Studies have shown that over the last century, roughly 40% of the total return of the S&P 500 has come from reinvested dividends, 40%. If you strip out dividends, the stock market's returns are dramatically lower. This is why I also believe in owning a dividend-focused ETF alongside a broad market fund, something that specifically holds high-quality companies with long histories of paying and increasing their dividends. Companies that have paid increasing dividends for 20, 30, 40 consecutive years. Companies with strong free cash flow and reasonable valuations. These are the businesses that keep paying you through recessions, through market crashes, through wars and pandemics and every other crisis. The dividend checks keep coming, and if you keep reinvesting them, the compounding snowball keeps growing. I have always said that my favorite holding period is forever, and dividends are the reason. When you own great businesses that pay you increasing dividends every year, time becomes your greatest ally. Every year you hold, you get paid more. Every dividend you reinvest, you own more shares, and every share you own generates more income. It is a virtuous cycle that accelerates over decades. Most investors are so focused on stock price movements that they completely ignore this engine running quietly in the background. Do not make that mistake. Now I want to share something with you that happened to me during the 2008 financial crisis, because it illustrates these compounding lessons in a way that nothing else can. In September of 2008, the financial system was coming apart. Lehman Brothers had just collapsed. AIG was on the verge of failure. The stock market was in free fall. People were genuinely afraid that the entire banking system might cease to function. My phone was ringing constantly. Friends, business associates, even strangers were calling to ask me what to do. Should they sell everything? Should they move to cash? Should they buy gold? And here's what I told every single one of them. I told them to keep buying. I wrote an op-ed in the New York Times in October of 2008 with the headline, "Buy American, I Am." People thought I had lost my mind. The market would go on to fall another 25% after I wrote that article. In the short term, I looked foolish, but I was not thinking about the short term. I was thinking about compounding. I was thinking about those 500 companies in the S&P 500. Were they all going to go bankrupt? Of course not. Were Americans going to stop buying food and clothing and medicine and gasoline? Of course not. Were businesses going to stop innovating and growing and creating value? Of course not. The economy was having a terrible moment, but the long-term compounding power of American business was intact. And the people who kept buying through that crisis, the people who kept investing in their ETFs every month while everyone else was panicking, they made extraordinary returns over the following decade. The S&P 500 went from its low of about 666 in March of 2009 to over 3,000 by 2019. That is more than a 450% return in 10 years. The people who sold at the bottom locked in catastrophic losses and missed the greatest bull market in history. The people who stayed invested and kept compounding came out the other side wealthier than they had ever been. That is the power of understanding these lessons, not just intellectually, but in your bones. The fifth lesson, and this might be the most important one of all, is that compounding works in reverse just as powerfully as it works in your favor. I call this the dark side of compounding. And it is the reason why avoiding big losses matters more than finding big winners. Let me explain the math. If you invest $100,000 and lose 50%, you now have $50,000 to get back to where you started. You need a 100% return. You need to double your money just to break even. That is the asymmetry of losses, and it is devastating to your long-term compounding. A 50% loss requires a 100% gain to recover. A 33% loss requires a 50% gain. Even a 20% loss requires a 25% gain. Every significant loss you take sets your compounding clock back by years. This is why I have always said that rule number 1 is never lose money, and rule number 2 is never forget rule number 1. Now, I do not mean that literally every investor has losing years. The S&P 500 has declined in roughly 1 out of every 4 years historically. But what I mean is that you should never put yourself in a position where a single bad outcome can destroy your ability to compound. And this is where ETFs provide one of their most underappreciated benefits: diversification. When you own an S&P 500 ETF, no single company can destroy your portfolio. If one company goes bankrupt, it represents a fraction of a percent of your holdings. The index removes it automatically and replaces it with another company. You do not even have to think about it. Compare this to someone who puts half their money into one stock because they are convinced it is going to be the next big thing. If that stock drops 80%, their portfolio is devastated. Their compounding is set back by a decade or more. I have seen this happen countless times. Brilliant people who were right about 99 things, but wrong about one thing. And that one thing wiped out years of gains. The ETF approach eliminates this risk entirely. You are betting on the American economy, not on any single company. And the American economy, despite wars and recessions and pandemics and every other crisis imaginable, has grown in value over every 30-year period in its history, every single one. There has never been a 30-year period where the broad stock market lost money. Never. That is the kind of bet I like to make. Now let me bring all 5 of these lessons together, because individually they are important, but together they create something extraordinary. Lesson 1, patience beats intelligence. Lesson 2, fees destroy wealth silently. Lesson 3, the biggest gains come at the end. Lesson 4, dividends are the secret engine. And lesson 5, avoiding big losses matters more than finding big winners. When you combine all 5 of these principles into a single investment strategy, you get something remarkably simple and remarkably powerful. You buy low-cost ETFs, you reinvest the dividends, you keep adding money regularly, you do not panic when markets fall, you do not chase excitement when markets rise, and you let time, the most powerful force in investing, do what it does best. This is not complicated. This is not exciting. There is no secret code or hidden strategy. It is boring. And that is exactly why it works, because most people cannot stand being bored. They need action. They need excitement. They need to feel like they are doing something clever. And that need for excitement is the most expensive emotion in all of investing. Let me tell you how this applies practically. If you are starting today with whatever amount you have, whether it is $500 or $50,000, the math works the same way. The percentages do not care how large or small your starting amount is. If you can invest consistently, even modest amounts, into low-cost ETFs every single month, and if you can do this for 20 or 30 or 40 years without stopping, without panicking, without getting clever, the compounding will do the rest. There is a concept called dollar cost averaging that makes this even more powerful. When you invest a fixed amount every month, say $1,000, you automatically buy more shares when prices are low and fewer shares when prices are high. You do not have to think about timing the market. You do not have to worry about whether today is a good day to invest. You just invest the same amount every month, regardless of what the market is doing, over time. This mechanical approach produces remarkably good results because it removes emotion from the equation entirely. You are not making decisions based on fear or greed. You are just following a simple system, and systems beat emotions every single time in investing. I have also seen too many people make the mistake of waiting for the perfect moment to start investing. They say they will invest when the market pulls back. They say they will start when they have more money saved up. They say they will begin after this current crisis passes. But the perfect moment never comes. And every day you wait is a day of compounding that you will never get back. Time is the one resource you cannot buy more of. A 25-year-old who invests $500 a month for 40 years at 10% ends up with about $3.2 million. If that same person waits until age 35 to start investing the same $500 a month for 30 years, they end up with about $1.1 million. 10 years of waiting cost them $2.1 million. Not because they did anything wrong during those 10 years, simply because those 10 years of compounding were lost forever. I think about investing the same way. I think about planting an oak tree. When you first plant it, nothing seems to happen. A tiny sapling sits in the ground and barely grows. After 5 years, it is still not very impressive. After 10 years, it is getting taller, but it still looks like an ordinary tree. But after 30 or 40 years, it is a magnificent oak that provides shade and beauty and value that would have been unimaginable when you first put that tiny seedling in the ground. Your investment account works exactly the same way. The first decade feels slow. The second decade starts to get interesting. And the third and fourth decades produce results that will take your breath away. But only if you do not dig up the seedling to check if the roots are growing. Only if you leave it alone and let nature do its work. There is one more thing I want to say about this, because I think it gets overlooked. When you invest in a broad market ETF, you are not making a bet on any one company or any one industry. You are making a bet on human ingenuity. You are betting that over the next 20 or 30 years, smart people will continue to innovate, continue to create new products and services, continue to find more efficient ways to do things. And that bet has paid off in every single generation since the Industrial Revolution. Think about what the world looked like 30 years ago. There was no internet as we know it today. There were no smartphones, there was no social media, there was no cloud computing, there was no artificial intelligence. Companies that did not even exist 30 years ago are now among the most valuable in the world. And the beautiful thing about an index fund is that you own them all along. You did not have to predict which companies would succeed. The index picked them up automatically as they grew, and it dropped the ones that failed. You just had to stay invested and let the process work. 30 years from now, there will be companies dominating the economy that do not exist today. Industries that we cannot even imagine will be creating enormous value. And if you own a broad market ETF, you will own a piece of all of it. You do not have to be a futurist. You do not have to predict which technologies will win. You just have to believe that human beings will keep finding ways to create value. And in over 200 years of American economic history, that bet has never lost over any meaningful time period. I want to talk about one more thing before I close, because I think it matters deeply. The reason I am so passionate about ETFs and about teaching people these compounding lessons is that investing is the great equalizer. You do not need to come from money. You do not need a fancy degree. You do not need to know anyone on Wall Street. You do not need to read 500 pages a day like I do. You just need to understand these 5 principles and have the discipline to follow them. A school teacher who invests $500 a month into a low-cost ETF for 35 years will end up with more money than most hedge fund managers' clients. A factory worker who starts investing at 25 and never stops will build more wealth than a doctor who starts at 40 and tries to catch up by taking big risks. The math is impartial. It does not care about your job title or your zip code or your education. It only cares about 3 things: how much you invest, how long you invest, and how little you pay in fees and losses along the way. That is the beauty of compounding. And that is why I believe that every single person watching this, regardless of your age, regardless of your current financial situation, can build real wealth if you start today and commit to these principles. I am 94 years old. I have been investing for over 80 years. I have made more money than I ever dreamed possible when I was that 11-year-old boy buying 3 shares of Citi Service Preferred. But the lesson that matters most, the one that I would write on a billboard for every person in America to see, is this. The stock market is a device for transferring money from the impatient to the patient. Be patient. Buy your ETFs, reinvest your dividends, ignore the noise, and let compounding perform the quiet miracle it has been performing since the beginning of capitalism. That is not just advice. That is the fundamental truth of wealth building. And it is available to every single one of you.